Hello, everyone. Welcome to our webinar, Battling Property Taxes, Understanding Your Valuation and How to Protest. A couple of key things I want to go over. We have the chat feature here available for you to engage with one another, ask questions to each other, and we'd like to use the Q&A feature for questions to the panel. So if we don't immediately answer the question, we likely will within the presentation. And we will also have time at the end of the presentation for Q&A. Another feature we will be using is polling. So we will cue you for that, and then we will give you time to answer those. So with that, I'd like to introduce everyone. I am Teresa Dominguez, the Director of Education and Marketing here at TSSA. And we have here with us Taylor Vaughn of Delta Property Tax Advisors. He will be presenting. We have Tammy Frost here from Ehlert Building Systems, our generous sponsor. And we have our Executive Director, Ginny Sutton. So with that, I will hand it off to Tammy.
Thanks, Teresa. Hi, everyone. I'm Tammy Frost, Divisional Sales Manager for Ehlert Building Systems, and we're really excited to be here today and to support the TSSA and to sponsor the Battling Property Taxes webinar. The Ehlert brand has been around since about 1975. We're located in New Braunfels, Texas, and we are a general contractor and a single source designer, supplier, manufacturer, and installer for all types of self-storage. Our business is built on relationships, and customer service is the underlying foundation for that. We enjoy many repeat customers and also welcome those who are entering the self-storage industry for the very first time. We have a really friendly staff that's ready and willing to help guide you through the process of developing your project, and will work really hard to save you money and wasted effort. We appreciate all the great folks at the TSSA for making this webinar available to all of us and for allowing Ehlert Building Systems to be a part of that. So now it is my distinct pleasure to introduce you to our speaker for today. Taylor Vaughn and David DeLeon founded Delta Property Tax Advisors to provide a unique approach to client relationships and property tax management. At Delta, their sole focus is managing and reducing property taxes. It's all they do. They don't subscribe to a one-size-fits-all approach. At Delta, they view their clients' tax strategy from different angles, making sure they aren't leaving anything on the table when it comes to the fair analysis of taxable value. And now, here to tell us a bit about how to battle our property taxes, Mr. Taylor Vaughn.
Thank you, Tammy. I appreciate the introduction. Today, we're going to be talking a little bit about property taxes and in Texas and ways that we can reduce those property taxes. I have an agenda created, and we're going to talk about the COVID-19. I know that's something that's on everybody's mind right now. We're going to go over briefly the Texas property tax calendar, the basic assessor methodology, how to file a protest, examples of the income approach and how you can use the income approach to reduce your property taxes. We're going to go over an equal and uniform example and explain it for all our listeners. And we're also going to discuss preparing for your hearing. We're ready to get started. First, we do have a couple of questions for our.
Yes, so I notice, we monitor these things and we have several hundred people registered, and I think people are slow to arrive this morning. We went through our intro so fast that they are coming in fast and furiously right now. So we may miss a handful of them as we launch this first question, but for those of you who are connected and have located, all you really have to know is where your mouse is, because we're going to put up this first question and ask you to respond by choosing one of the options. And let me get the right question up there. And our question today is, what is your role with regard to a self-storage facility? So please choose one of these options. If you'll go ahead and start voting. Facility owner or partner, third-party fee manager, facility site manager, supplier or vendor, or other, if you identify as other. And people are voting like crazy. Lots and lots of responses. I'm going to keep watching as we get close to our number. We're getting pretty close. You have about 5 more seconds. So go ahead and vote. I'm going to go ahead and end the poll, and we're going to display our results. So Taylor, today with us, you have almost 80% are facility owner or partner, 12% facility managers, 5% supplier or vendor, and 5% of those people who decided to identify themselves as other, none of the above. So we'll go on to our next poll question, which should also be quite easy for people to answer. It's a very simple and straightforward question, which is, have you ever protested your property's tax valuation before? Yes or no? This one's going even faster because people don't have to read all the text. It's either a yes or a no. And we are almost there. 5 more seconds. All right, about the same number of votes as the last time. So I'm going to go ahead and end the poll and share the results. 65% said yes, and 35% said no. So Taylor, you have a somewhat experienced audience today, and I'm sure that will color how you cover things. So I will stop sharing, and we'll turn it back over to you, Taylor.
Okay, thank you very much for those questions. That does help me identify where to spend most of my time during this presentation. It sounds like several of y'all do have experience protesting your property taxes. And so we'll get first started on COVID-19. I know this is a subject that everyone is worried about and how it's going to affect property taxes. We do hope that everybody out there is being safe right now and practicing social distancing. So the property tax code provides for a temporary exemption of real property damaged by a disaster. As you all know, that the Texas Attorney General issued an opinion. He issued a disaster declaration, and the governor did, and the Texas Attorney General did issue an opinion on April 13th, 2020, that the disaster exemption does not extend to property suffering purely economic losses. The phrase damaged by disaster concerns only physical damage regarding repairs to get the facility back to its pre-damaged condition. The opinion concludes that this purely economic, non-physical damage to property caused by the COVID-19 disaster is not eligible. So for property tax purposes, the COVID-19 disaster does not apply to property taxes and getting a reduction in property taxes. We've had some additional information come out from the Texas Comptroller regarding COVID-19, and he was regarding the assessment date. The lien date in Texas is January 1st, and he has conducted considerable research, and he has said that it's clear that the COVID-19 did not affect property values as of January 1st. We are expecting that the property tax appraisal districts to rely on this January 1st date and not give any type of exemptions or any type of relief regarding the January 1st lien date. This does not mean that we're not expecting some compassion from the ARBs and from appraisal districts. We know that a lot of people are suffering with lease up right now. They don't have people actually in the office, sometimes actually working the properties. And so we do expect that there to be some type of consideration given, but regarding the property tax code, there is no relief that is guaranteed for self-storage. Another thing I want to point out is due to the significant reduction in sales tax that the state has received, we are expecting tax rates to increase. And Senate Bill 2 that was passed in the legislative session last year, property tax liability, or the jurisdictions could not increase the property tax rate by more than 3% unless a disaster was declared by the governor. If the disaster is declared, property taxes, the actual tax rate can increase up to 8%. And so we want our owners and people who are responsible for projecting property taxes to be aware that we are expecting property tax rates to increase across the state of Texas to make up for the loss in sales tax. So that's something that you should probably be ready to accrue for. So first, we're going to start with a brief overview of the property tax calendar. It's important to understand what the assessment valuation date is, and it's January 1st. Whenever you receive your notice of value, the appraisal district is looking at what your property is valued as on January 1st. And that relates back to the COVID-19 disaster that was declared after January 1st. And so if you were to sell your property, what would it sell for on January 1st? And that's an important date to remember whenever you're arguing your property taxes. Around April, notices are mailed. We've seen notices come out a little bit later this year. There are some counties, I know Dallas County, for example, hasn't issued notice, and they said they won't issue notices until June 15th. And so just be aware that typically around April, notices are mailed. If you haven't received your notice of appraised value, you can always go online and search for your property and see if it's been updated in their system. That's coming a little bit later this year, but typically around April, notices are mailed. This is actually a really good time for this presentation because May 15th is the statutory protest deadline. You're also allowed 30 days after notices are mailed. And so be aware of the date. May 15th is just right around the corner. Travis County, for example, May 15th is the protest deadline for all property, all real property in Travis County. So make sure that you don't miss your protest deadline date. These are very strict. If you file a late protest, you may not get any relief. So during May, June, and July is whenever a lot of the informal and formal hearings happen. We're going to walk through what an informal hearing looks like and what a formal hearing looks like. But typically these are happening during May, June, and July. This time appraisal districts are asking for a little bit of time to get through all the informal and formal hearings. Things have changed because of the unusual circumstances that we're in right now. And we're going to go over what I've been hearing from appraisal districts and how those hearings are going to happen this year. So July 25th, values are certified by the appraisal district. When I say values are certified, that means 95% of the appraisal roll has to have either been settled or had their ARB hearing and be completely finalized for the tax year. This is so they can get their information to the taxing jurisdictions so they can develop the tax rate for that year. October, your tax bills are mailed, and then January 31st of the following year, your tax payments are due. This is a really important date, especially if you're pursuing litigation. If you do not pay your property taxes by January 31st, you do not have the right to pursue litigation. You can either pay what you think that you owe or pay the amount that is due. But if you don't pay anything, then and if you try to pursue litigation, you may be out of luck. Now, how about your 2020 notice of appraised value?
Sorry about that. One of our good friends was texting me right in the middle of that, and I got distracted by it. Taylor, who's a friend of yours who referred us over. I can never get him to stop texting me during live webinars. All right, so now if y'all have had a chance to think about this for a minute, and Teresa, did you already launch this poll? No, sorry, got it. Let's get that question up here. I know this is a painful question to answer for many of you, but if you will look at the choices here and answer honestly, if you receive notice already, how much did the value of your self-storage facility increase compared to last year? 1 to 10%, 11 to 20%, 21 to 33%, 34 to 50%. This next one should be 51% to 100%, more than 100%, more than 200%, or lucky dog, the value went down. So this one's taking a little longer, I think, because there's so much text up here to read and to take in. Watching the responses, not quite at half of you responding. And of course, some of you aren't going to respond. As Taylor said, some of the notices went out late, so you don't know yet what's in store for you. Got about half of you voting. You're still coming in fairly regularly. I'm going to give you about 5 more seconds. If you'll choose one of these, we'll display our results. All in. Got a little flurry going on now. A little under half of the group voted, and so that may mean a lot of folks have not received their appraisal notification yet. I'm going to go ahead and end the poll and display our results. So 27% of you, 1 to 10%, 20%, 11 to 20%, 20% of you, 21 to 33% increases, 12%, 34 to 50% increase, 8% are in the 51 to 100% range, 6% more than 100%, and 4% more than 200%, with one person saying their value went down. So as expected, we didn't have a lot of those. Take all that in, Taylor.
Got it.
All right. I'm going to stop sharing and turn it back over to you.
Okay. Thank y'all for participating in that poll. It kind of helps us gauge how appraisal districts are approaching self-storage this year. And I want to give a brief walkthrough of the mass appraisal approach. Self-storage, unfortunately, is easy to pick on because during how the county uses the mass appraisal approach, self-storage facilities can be easy to target. It's important to understand that the appraisal districts are geared towards high output appraisal processes. And so they are valuing your property along with thousands of other properties that are similar to your property. And so it's going to be difficult for them to take in the subjective nature of each property and make adjustments for those. In the mass appraisal approach, and the income approach to value is the most common approach that we see for self-storage facilities. Assessors typically begin with voluntary income and expense surveys. I have clients send these to me every single year, asking me if they have to fill these out and send these back to the appraisal district. We typically tell them that there's a special filing cabinet for those, and that's the trash can. And we don't provide this information to the appraisal district. But what they're doing with these voluntary income and expense surveys is they're taking in the data and they're calculating a couple different things so that they can complete a mass appraisal approach. They're looking at normal and typical gross incomes, normal vacancy rates for their area, expense ratios, and net incomes. And they're combining all this information to apply to a single class of property, whether it be self-storage or any other type of income producing property. What they want to try to do is be as uniform as possible, so they'll gather their information and process it and apply it over all properties that are in that class. Lastly, the counties develop cap rates and typically look at local sales data. If they have that, they'll also send out sales surveys. They typically send one out to the seller and to the buyer asking for what the purchase price was and for any information regarding the property. I highly discourage people from sending those back to the appraisal district because they're using those to try to develop cap rates and look at what properties are selling for in the market. If they don't have good information, they'll look at local relevant publications, and there's a lot of stuff out there that's available to the appraisal district. Most of them do have access to CoStar, but there's also the Real Estate Center at Texas A&M has information regarding cap rates. I know Marcus and Millichap is another one that publishes good data that can be sent out and be used by the appraisal district. The mass appraisal approach does have limitations, and these are what are to be aware of whenever you're doing your protest. There are property-specific characteristics that it's impossible for them to take in because of the number of properties that they're responsible for appraising. These are a couple of examples of types of characteristics that are not really considered in the mass appraisal approach. Location, economic occupancy, it's impossible for them to know exactly what your vacancy rate is for every single property out there. The size of the facility, any type of external risk. If you know that there's a competitor coming in and it's going to affect your property, the appraisal district isn't going to take that into consideration whenever they're doing their mass appraisal approach. Functional flaws within your property that are unique to your property. And if you have any needed repairs or capital expenditures that you know of that are coming up in the next year, without you actually telling the appraisal district that information, they're not going to be able to be aware of that. So now it's time to determine whether or not a protest is needed. And there's really two different things to look at is how does your assessed value compare with your own value analysis? If you own self-storage in Texas, it's more than likely that you've been contacted by somebody asking to sell your facility, and you probably have a pretty good idea of what your facility is worth if you were going to sell it. If not, you can complete your own valuation analysis using the income approach, and we're going to walk through an example of one here in a little bit and how to do it. And then the other determination to look at is, how does your assessed value compare with comparable properties in your market? You know your markets and you know the properties that you have around you. The appraised value information is available online of those properties. And so you can go and look and see, have they targeted your property, or has your property gone up more than other properties in your area? And lastly, do not discount the impact of value precedent moving forward. If you file a protest, you may not get a significant reduction in year 1, but that could roll over for years 2, 3, and 4. I don't know how many times I've been told by the appraisal district that I can't go below last year's value. I can't go below last year's value. And so even if you do think that the adjustment may be small, or that they're just a little bit over what the market value should be, it's still worthy to file a protest, because that will help you in future years going forward. So how do you protest? I know a lot of you have already protested your property, so I'm not going to spend a lot of time on this, but there's a couple points I do want to point out. You can download the form from the comptroller's website just with a Google search of Texas Property Tax Protest Form. You can also do it online. A lot of counties are becoming more sophisticated nowadays, and you can check your notice to see if there's a PIN available, and you can log into your account and you can protest online, exchange evidence with the appraisal district online, and even receive informal offers online. Many of the notices that are sent out also have the backside of the notice of value has a place where you can submit your protest by filling it out and then sending it back. Lastly, you can also create your own protest letter and send it in via certified mail. Don't forget, there's a couple things that we recommend. Always send it by certified mail to confirm receipt of it, to make sure that the protest deadline was met timely. Keep a copy of it for your records. And lastly, this is a really important point, insert language to get a copy of the assessor's evidence. Here's a copy of what we include on our protest letters. If you insert language to get a copy of the appraiser's evidence, they have 14 days. They have to give you the evidence at least 14 days before your hearing is scheduled. These slides will be available afterwards, and so you'll be able to have this information. But you can also email me at Taylor@Delta Property Tax for a copy of our protest template, and I'll happily send it to you as well. So what happens when I file a protest? A lot of people think that a protest is a very contentious arrangement, when it's really not. It's pretty friendly. Remember, the assessors are dealing with mass appraisal approach, and they're getting thousands of protests in every single year. So when you file a protest, it doesn't just mean that you're going in to start a fight or that it's going to be a bad relationship. What it does allow for is informal negotiation, and it does open up communication with the assessor. You can call them after you file a protest, they can call you, and y'all can start gathering information regarding your property. The assessor cannot make changes to your value without an active protest on file. And so that's another reason to file a protest. You may call your assessor, talk to them about your value, and y'all agree that there's a reduction that is due to it, but without an active protest on file, they're not supposed to actually change your value. And lastly, it allows the opportunity to review the assessor's work papers. And this is where the evidence request comes in, and getting a copy of how they've actually valued your property so that you can look at that and compare with your notes. One thing I've heard before is people think that if I file a protest, it's going to put a target on my back. There are thousands of protests being filed every single year, and the appraisal district is using mass appraisal approach whenever they value property at the beginning of each year. And so in my experience, there has not been an instance where they filed a protest, they got angry, and they went after you year after year after year. It's actually a pretty informal process, and it's a pretty friendly process. Now, whenever you file a protest, you do have a couple choices to choose on how you want to file your protest. The first is incorrect appraised or market value. And this is probably one of the most common ones that's filed, and it's basically the price at which a property would transfer cash or what you would be willing to sell it for if you wanted to sell it. The next one is one that's relatively unused, and I think it probably has the most potential for getting reductions, and is the value is unequal compared with other properties. And what they're looking at is the median adjusted value of a number of compared properties. What we typically recommend is we pick both of these. Unless you pick your value is unequal, the assessor is not able to look at that and make an adjustment based off of that. And the owner can withdraw one and leave the other one active. And so if you start talking to the assessor and you feel like, hey, my market value, I'm a lot higher on market value, but my equal and uniform is not higher, I should be lower, you can always withdraw your market value protest and still leave your value as unequal compared to other properties protest available. So we're going to go over each protest type and look at ways that we can negotiate with the appraisal district and try to get the values reduced. The first is we're going to look at market value. And this is basically your income approach versus the assessor's mass income approach. There are a couple areas of negotiation when it comes to market value. Gross potential income, economic vacancy, operating expense, and capitalization rate. And remember that the appraisal district is relying on surveys to calculate their information that they're using. And so any information that you can bring into the assessor regarding these areas of negotiation and bring to their attention, they're typically pretty well receptive of the information and will make adjustments. So gross potential income is the potential income from all sources. One thing to note is this is different than contract rent or what you have actually collected over the past year. They're looking at if your property was at market value or all your rates were at the market rate, what would you be able to bring in? So it's important when you're looking at gross potential income to pay attention to your property specific factors. One thing you may want to look at is what were your rental rates as of January 1st, as of the lien date. They're going to be using your most recent rental rates to calculate your gross potential income. Another area is economic vacancy and collection loss trends. You may see towards the end of the year, you may have had to start offering additional incentives for people to sign. Maybe it's half off 3 months where it used to be half off of 1 month. And there are specific factors to your property that may not be applied to every single property just based off of the market that you're in. The age and condition of your property is also something that needs to be taken into consideration. If your property is 15 years old, they may be applying the exact same factors to a property that's only 3 years old because they're applying the mass appraisal approach. And then lastly is net rentable square feet. We've had examples, and I have one later on in the presentation, where the county is using a lot of aerials to calculate what the net rentable square feet is, and it may not equate to what you're actually able to lease out at your property. You may have an office that you occupy. You probably have hallways in your climate controlled units, and the county is looking at either permits or aerials to try to determine what the total square footage of, and that can be different on a lot of cases. Okay, next we're going to talk about operating expenses. It's important to know that the operating expenses that the county is using do not include costs that are beyond the direct operation of an income producing property. Repaving a parking lot would not be considered an operating expense for property tax purposes. Mass appraisal approach relies on the operating expense ratios for uniformity. One of the most important factors that the appraisal district is looking at is they want to try to be uniform across all different property types. And so they may have an operating expense ratio of 45% that they're applying across the board to everybody. If your facility has higher operating costs compared to the appraisal districts, evidence needs to be brought in to their attention why. I recently had an example. I talked to a self-storage owner, and he didn't have an electronic gate system. And so he was having to pay someone every morning to go out, open up the gates, unlock the gates. This was a smaller facility. And so his operating expenses were higher than that of some of the other facilities. And so that's one example that you may want to look at is there something unique to your property that causes your operating expenses to be higher than that of other properties in your area? Another thing that's important is property taxes are not deducted as an operating expense. And I know they typically are if you're doing an income valuation, but in the property tax world, the property taxes are the dependent variable. We don't know what the property taxes are going to be yet. And so we don't include them in the operating expenses. Instead, the best method to account for property taxes is to load the cap rate. And by loading the cap rate, what we do is we take the operating expense, we take the property taxes out of the operating expenses, and we add the tax rate to the cap rate. So if your cap rate is 6.5% and your property tax rate is 2.5%, then we would add those together and use a cap rate of 9%. This makes sure that we still account for the property taxes in your income approach and that it's reflected in your value. But until we know what the actual property taxes are, we can't account for them in your operating expenses. Another example is operating expenses is if you have climate controlled units and non-climate controlled units, you may have higher utility costs. And so it's important just to look at what is specific to your property that may not be included in the mass appraisal approach that can say that your operating expenses are higher than what they're estimating. Next, we're going to talk about capitalization rates. And we all know that cap rates vary market to market and even property to property. Many jurisdictions use one cap rate per property type or class. One county that I work in particular, for every Class A property, they use a 6%. For every Class B property, they use a 7%. And for every Class C property, they use an 8%. And they use it across the board. And so that we know that there are different risks associated with different properties that would make the cap rate be adjusted. And so that's something to take into consideration is what cap rate is appropriate for your property based off the long-term risks that are associated with that property. Most counties are willing to adjust cap rates, and typically they're based on long-term uncontrollable risk that affect your property. This may be an instance of a new facility that's being opened up nearby. That would be an example of a long-term uncontrollable risk. If you have a parking lot that needs to be repaved, or you have some CapEx that needs to be done to get your building up and operating to a stabilized level, that would probably not be an example of an adjustment in a cap rate, but it should be taken out maybe somewhere else. The best place to find cap rates is to look around and talk to brokers in your area. You may have friends in the industry that have recently sold properties. You can also look to property tax consultants, and then there are several sources on the web to find cap rates for a market to prove that cap rate may be higher or lower than what the appraisal district is actually using. And always be sure to load the cap rate. This is one area that a lot of people tend to leave out, but until we actually know what the property taxes are, we want to make sure and load the cap rate so that we can include that expense in the valuation. Okay, so this is an example of a mass appraisal approach that's given by a county for a self-storage facility. In the middle, I have the mass appraisal approach, and I have on the left-hand side a description of how the county is valuing this property. And you can see there's not really a lot of columns on the left-hand side that the county uses. And this is what helps them with the mass appraisal approach value self-storage facilities so easily. They just look at the net rentable square feet, and it typically applies some type of multiple to arrive at their gross potential income. The columns right here in the middle, these are all coming from a county. And so this is an example from a county that they use to actually value this property. What I do whenever I'm arguing a income approach property is I look at my facility and then I try to mimic are. And I typically highlight where the differences are. And we have a couple examples here. The first is the actual net rentable square feet. This is an example of a facility that was climate controlled and the assessor was not removing the hallways and the office from the net rentable square feet. So they were applying their rate to the entire square footage of the facility when our actual net rentable square feet was significant or was a little bit lower, but it makes a big difference in our gross potential income. Secondly, we looked at our rent roll and we looked at the last 3 months and we took an average of what were we actually collecting on an annual basis. And ours averaged to $13 per net rentable square foot. And so whenever I bring in an income approach and I'm arguing an income approach, I would have additional information to support the $13 per square foot. And it may be a rent roll or it may be a printout of your online rates if you have those posted online and available, but something to show that they may be high on their gross potential income because they're using market surveys and maybe including properties that are inside the city limits and you're outside the city limits. And so there are different factors in play to affect what your gross potential income actually could be. Next, we look at the vacancy. I like to look at economic vacancy. And in this example, I have 3 years worth of history. And you can see on the right-hand side, the economic occupancy for 2019, 2018, and 2017. And what I did was I took an average of that occupancy and I used that as my vacancy rate. It looks like, based off the history of this property, it is stabilized at around 83% occupancy, which would equate to 17% vacancy. And so going forward, that would be something that I would consider to be stabilized. Now, if those numbers varied significantly over the years, there may be additional subjective measures or adjustments that need to be taken into account. But just looking at the history, what this property is telling me is that 83, 85% is typically where we're stabilized at, and that would be adequate to use as a vacancy rate going forward. If I look at line number 6 on the operating expenses, I didn't think their operating expenses were bad, so I used the same rate as the county did. Again, I would look at my own operating expenses to see how they compare to it. In this instance, I liked it, and so I left in their operating expenses. Lastly, the biggest difference was I took out their property taxes. And actually on this property, the taxes would have been about $104,000 if they would have used the $4,000,001 income. And so their property taxes were a little bit low because they're applying a price per square foot of $1.32 to calculate the property taxes. And so this is the reason that we load the tax rate instead of including the property taxes inside our operating expenses. It's typical for them to have a management fee in place. It's typical for them to have a reserve for replacement in place. And then they have an total expenses, and you can see their operating expense ratio is 60%. Ours is a little bit lower because we're taking out the property taxes at 53%. So we get to our net operating income, and then on line 12, you can see where I've actually loaded the cap rate. And on this one, I used a little bit higher of a cap rate. I said our cap rate was 7%. We are not located inside the city limits, and so we do have a couple locational issues. And then we used a 2.5% tax rate, added the 2.5% tax rate to get to a total of 9.5% cap rate for our property. And you can see on line 13 that there was a significant difference in the mass appraisal approach versus the taxpayer's actual approach. So a lot of these adjustments are subjective, but I would always make sure and bring in good evidence to support each line that you're changing and be able to explain why you're able to change or why you are changing what the mass appraisal approach is doing. But it's a pretty simple approach that the appraisal district takes into account, and that's because they're doing hundreds of these properties every single year, and they don't know the specific characteristics of your property. And so I like to take in a format that mimics what the appraisal district has actually done. That way I can easily identify where the differences are. Okay, the next approach is the equal and uniform approach. This approach has gained a lot more of attention in the past couple of years, and this is a really effective approach to use if you feel like your market value is low and your income approach is pointing to a higher number. And actually, in Texas, is very favorable to taxpayers. Courts have upheld that an assessment should be based on the lower of market value or equal and uniform. The emphasis in the equal and uniform protest is on properties that are appropriately adjusted. And most adjustments are made based off the asking rates of the properties. If you have a list of comparable properties and you know what their asking rates are, if they're higher than yours, then in theory, that would be a superior property to your property. If they're lower than yours, then in theory, that would be an inferior property. And so you would make an adjustment based off the percentage difference. And we're going to walk through an example of exactly how that works. In order to determine what the rental rates are, you can conduct a market survey, talk to the other owners, look online at their websites and try to figure out what their rates were or what they were asking for as of January 1st. But do please keep in mind that January 1st is the lien date. And so that's the date that we're looking at rates, is what were they as of January 1st and how did they compare to your facility? Lastly, you can also make some subjective adjustments in addition to the adjustments based off of the asking rental rates. And we're going to kind of go over those in a little bit more detail and how to make those. These are really, subjective adjustments are really based off of experience and your knowledge of the comparable properties. You probably know your property better than anybody, and you probably know the comparable properties better than the appraisal district. So there are a couple things that we look at when we're making subjective adjustments. The first is going to be location. Where is the property located? Do they have a superior or inferior location than your property? The next that we're going to look at is class. Are they an A-class property, a B-class property, or a C-class property? Additionally, we'll want to look at quality or year of construction. This will be important and will typically show in market rates that they're asking, but we all know that sometimes properties, especially people that have owned their property for a long period of time, aren't as aggressive with their rates. And so they may not be asking market rate. They may be just trying to stay full and not have a lot of turnover. And so this is the instances where we would use some type of subjective adjustment, is we know that they're not asking market rates for their property. Lastly, we have condition of the property. If you know something that about the other property that needs to be fixed or it's in need of repair, these are type of adjustments that can be made to your property. Again, all the adjustments based on market rent assume that the comparable property is asking market rent for their property. If you've done your analysis and you know that they're not asking market rates or that they could command a higher rate if they wanted to, this is where a subjective adjustment would play in. And that's just based off of your knowledge of your comparable properties and your knowledge of the market. So we're going to take a little bit to talk about making appropriate adjustments. And this is a nice little graphic I like to use whenever I'm making adjustments. It's important to know whenever you're making adjustments to a comparable property, you're never adjusting the subject property. The subject property always stays the same. But let's say that you've identified a property that is inferior to your property, whether it be location, class, quality, or any of the other characteristics that we named. In that instance, you would adjust that inferior property up to your property. We're trying to make it match your property as much as possible. And on vice versa, you've identified a property that you believe is superior to your property. In that instance, you would make the adjustment down on the superior property to match your subject property. And so it's just important to remember that we're not adjusting the subject property to match the comps, but rather we're trying to adjust the comps to match the subject property as much as possible. So whenever you're presenting an equal and uniform dispute, it's important to gather a list of comparable properties and get their assessed values. These can be obtained online, and you can also make an open records request to the appraisal district if you can't get all the information that's available to you online. They have 10 days to get back to you on that. There are services out there where you can download the entire appraisal roll if you want and get a list of every single property that is a self-storage facility that's in the county and use those as comparable properties. You'll want to identify units of comparison, and this may be price per square foot, net rentable square feet, but you'll want to make sure that you're actually using comparable properties and not comparing a property that may be 60,000 square feet to a property that's only 15,000 square feet. You want to try to be similar to your property as possible. Whenever we present our equal and uniform cases, we exclude the land value. The property tax code requires land to be valued as vacant and available. And so they do a separate valuation on the land and assign the value using that way. What we're doing is we're trying to compare what are the improvements? How do my improvements compare to the improvements of another property? You'll want to make the appropriate adjustments. And then what we'd like to do is summarize the adjusted values and be sure to calculate the median, which is what the property tax code identifies as the measure to use, is the median value of appropriately adjusted properties. I try to have at least 4 comparable properties whenever I'm presenting an equal and uniform case. The more you have, the better. Sometimes it can be difficult to find properties. And I also try not to exclude properties that really are comparable properties, even if they indicate a higher value. The county's going to pick up on that right away. They're going to run an analysis and be able to look at the properties that are close in your market area. Counties are getting better and better at using software and being able to identify properties. And so it's important that if you show some bias in your approach, it may not play well if you end up going to the appraisal review board. So even if a property doesn't help you in an equal and uniform dispute, you may still want to keep it. And that's part of the beauty of using the median appraised value is it kind of throws out the highs and it throws out the lows. And we're kind of looking at what's going on in the middle and where's everybody else at. So this is an example of a equal and uniform approach that we've presented to the appraisal district before. You can see in the top rows, I've gathered a list of comparable properties and identified units of comparison. Effective year construction, the class of each property, the size of each property is similar to mine. And then I've added their assessed values to it, removed the land values to look at what is the appraised value of the improvements themselves. And if you look at line 8, that's highlighted in gray, you can see that the subject improvement value per square foot is at $67.46. This is significantly higher than 3 of the properties. Property number 4 is appraised on a little bit higher than us, but I know some information about that property that we'll get into once we start making the adjustments. But at first glance, this is typically the first analysis I do is lines 1 through 8. And I look at how am I being compared to other properties right now? And then I may start looking, it may draw my attention to another property to look at why is that one so low or why is that one so high. Next, on line number 9, I want to include my adjustment notes. And so these are really important, especially whenever you're presenting information to the appraisal review board, because they are going to be glued looking at your presentation. And so you could go over these and explain each adjustment to them, but the more that they have in front of them that they're able to see why you're making an adjustment, the easier it will be for them to process that information. So I've looked at what the effective rents per square foot are for all the comparable properties, and that's how I've made my first adjustment, and that is rows 10 through 12. Ours is $13 a square foot. We have a facility that's commanding a higher price than ours at $13.50. That's comp number 1. We have comp number 2 that's commanding a lower effective rent per square foot. But I do know this property. It's an older facility. It's a Class A. It's a little bit bigger property. And I personally, because I know this property and I've done my research, I think that they're low on their rents. I think that they could be asking a little bit higher. And so that's where I've made a subjective adjustment on this property that we'll see on lines 13 and 14. The effective rent calculation is pretty easy to make. You just look at the percentage difference between what the effective rent per square foot is for the comparable properties, and then you make that adjustment to match your property. The adjustment percentage is we're adjusting the comparable properties. And so on comp number 1, line 8, you can see that their improvement value per square foot is $54. They're a superior property to us because they're asking more rent than we are. They're a newer facility as well. And so we're adjusting that property down. We're trying to get it to match our property. So I'm adjusting their $54 per square foot down $2 a square foot. If we keep going down the line, I'm doing the same thing for number 2, comp number 2. Comp number 3 is kind of a unique situation, and this is an example of one that we've actually done before, where the county had this property classed on row number 3 as a B property. And I know this facility, I've looked at this facility. I'm not sure why it's classed different than ours. It is very comparable in size to our property, and it was actually newer than our property is too. Their rents are lower, so I am making an adjustment up based off the rents. But because I've driven by this property and I know this property, I really don't think that that's a fair adjustment to make. I think their rents are low. I think that they could be charging more in rents. And so I'm going to make a subjective adjustment to that property based off its quality and condition. And I did that at 15%. And so the net on that property comes out pretty close to a slight adjustment up overall to that property. Comp number 4 is a really unique property. They started at $79.21 per square foot. But again, I know this property very well, and I know that this property has a ton of RV storage on it. It's not covered, but they're probably generating 50% of their revenue through RV rentals. We don't have any RV at our facility. We're a strictly climate controlled and non-climate controlled facility. And so that's kind of what's skewing the improved value per square foot, is because they're applying a lot of income to the RV that is being reflected in the improvement value per square foot. So I'm going to make an adjustment based off of that, and it's going to be a downward adjustment of 30%. I know about 50%, about half this property is RV, and that's something that we don't have, and so that is something to be taken into consideration. What's important to know is on these adjustments is it's very subjective, and so when you're looking at properties, whatever you know about the property is going to be helpful whenever you're making these type of adjustments. Nothing can be necessarily ruled out. If a property is different than your property in one way or another, feel free to go and make an adjustment for that property. Once you bring it in and you start talking with the assessor about your comparable properties, you may find more information about the property that could cause another adjustment to be made later on. So on conclusion, down at the bottom, I've got some adjusted improvement values, and I'm basically calculating what the adjustment improvement values are per property after I've made the appropriate adjustments. And it looks like I do have some questions here. Let me take a look at those.
Taylor, before you leave this slide, one of the questions was about the class and how you determine the class of the property.
Okay, let me get back to those.
And by the way, while he's adjusting back to that slide, I'm not sure, we had a lot of people come on late today. If you did not notice the question and answer feature, if you're not sure where that is, just mouse over somewhere on the Zoom screen and you should see a place where you can submit your question. Some we've been answering privately, others are still waiting to be asked, but now's a good time to do that as we're rolling into the last few minutes of the webinar. You need to submit your questions. Thanks, Taylor.
Yeah, thank you. So the class of the property actually comes from the appraisal district, and this is how they assign and generate their mass appraisal approach. And so that information actually came from the appraisal district. A lot of it is available online, and some of these I have to call in and I have to say, hey, what do you have this property classed as? Or I'll have to request information on that property through an open records request to actually get that information. But the class does come from the property, from the appraisal district, and it's typically how they're applying their mass appraisal square foot, their mass appraisal approach is based off the class. Let's see, I had a couple other questions. Okay, how long after the purchase of a property can you use the purchase price of the valuation for your protest? So the county can use the purchase price for 2 years whenever they're doing a sales comparison approach. And so if you've purchased your property, I would say 2 years is probably a good estimate of how long you can use that for. If you've increased your rents and you've increased your net operating income, then you can probably expect a slight increase in your appraised value, but you can submit that evidence for 2 years. Okay, let's see. How do you calculate effective rent per square foot? So what I do on that is I take my total net rentable or potential income that's available and look at the total square footage of the property and calculate it that way. There's a couple different calculations that can be used, but ideally you'd want to have total net rentable square feet, and then you'd want to have a breakdown of their price that they're asking per unit. Okay.
Can you see that next question, Taylor? Can we?
Which one?
Right, yeah, the next one is, can we use land value as our main issue or the main reason for protesting? Our land value went up 501%. We're an older facility. The land around us went up 13%.
Yeah. So since land is valued as vacant and available, you can also do an equal and uniform approach on land as well. Typically, if you would see an increase, I would want to see an increase on the improvements if you're using the income approach. But it's because land is valued as vacant and available, you can do a similar type of equal and uniform approach based off of land that is adjacent to your property or really close around you. Why we take the land value out whenever we're making our adjustments is because the effective rent per square foot typically adjusts for the location. In theory, if you're using rents, you're making adjustments for location. But if you want to argue land by itself, you would need to put together an equal and uniform approach just using the land and do a similar concept. And a lot of times I'll have an aerial and I'll show which parcels I'm using that are surrounding me or adjacent to me, how much they went up or down. And then on land, I may make adjustments to like corner influence or how much land do you have. Typically more land sells for lower per square foot and vice versa. Okay, let me get back to this, finish up this equal and uniform, then I'll get back to some more questions. So the protest type, I always like to summarize my results. Well, whenever I'm presenting an equal and uniform case, a lot of times I'll see ARB members just go directly to the last page of my presentation. And so I like for my last page to be a summarize of where am I at up here in the corner, and then where are the adjustments at after I have already made all the appropriate adjustments on this property. So they can see that there's a substantial difference. And then they'll slowly go back. It's almost like they like to work backwards to forwards. They want to know, what number am I asking for? And I like to prove to them, I like to summarize the results and showing how I'm getting to those values. So preparing for hearing. So Jenny, would like me to answer some more questions right now, or continue with the presentation?
I would say go ahead and finish. How many more slides do you have, Taylor? Maybe just a couple more?
Yeah, just a couple more. There's not many.
Okay, I'd finish that and then we'll go ahead and answer the questions that have come through.
Okay. Okay, so I'll go through these fairly quickly so we have plenty of time for questions. But when you're preparing for a hearing, be sure to have lots of evidence. Your evidence will always trump arguments. And so to be prepared, the burden of proof, Texas is a taxpayer-friendly state. So the burden of proof is on the appraisal district. They have to establish the property's value by a preponderance of the evidence. So it's a very high burden. This is really good news for taxpayers. Whenever you walk into an ARB hearing or an informal agreement, you are automatically assumed to be right. And the appraisal district has to prove by preponderance of the evidence that your number is wrong. And so this is really good news for taxpayers, and it really helps us out whenever we're going through it. Whenever you file a protest, you'll have an informal hearing, and then you'll also have a formal hearing if you don't reach an agreement during the informal process. So during your informal hearing with the assessor, we like to say use the KISS method. Keep it very simple. Simple is typically better. They're using mass appraisal approach. And so if we bring in a P&L with 30 or 40 rows of different types of operating expenses, that can typically be confusing, especially if you're presenting it to an ARB. So the more you can combine information and present it, the better. Clearly identify objections and provide support evidence. I try to limit to about 2 to 3 issues whenever I'm bringing in an argument. I don't want to overwhelm them and provide so much information that they don't know necessarily exactly what I'm arguing and how many points are. So I do try to limit that. This is during the informal process is your opportunity to ask questions of the assessors. You can ask questions about other properties that they're using against your property, about how they're deriving their cap rates, about how they're getting their gross income, potential gross income. And you might find out good information during your informal hearing process that can help you if you don't reach an agreement with the formal hearing. And lastly, avoid arguing with the assessor, but instead point to your evidence for credibility. I always like to say I have 2 clients. I have my client that I represent, and then I also have the assessor that I have to work with year after year after year. And so I know that if I upset the assessor or I get into a really big argument with the assessor, he's not going to want to work with me going forward, and he may just send me to the board every single time. And so it typically is a fairly friendly process, and it's about evidence exchange. And they do, for the most part, just want to get to the right number. And if you present evidence to them that is different than what they have in their hands, most of them are pretty good about making adjustments and taking that evidence into consideration. So if you don't reach an agreement with them during the informal process, that's whenever you move on to a formal hearing with the appraisal review board. This is typically a 3-member panel, and they're made up of local citizens within the county. Whenever I have a presentation ready, I always number my pages. If I come in with a 4 or 5 page presentation, the first thing they're going to do is flip to the very last page, and I may want to point to their attention on something on the second page. And so it's very easy for me to say, if you look at page 2, if you look at page 3, and that will get their attention to make sure that they're following along with your presentation and not just skimming through it. Always indicate your opinion of value and include a summary page. They're going to look at the very last page, and that's probably where you're going to end your presentation. And so on the very last page, I like to have my notice value, a summary of kind of my points, and then where I'm at as far as my indication of value. You'll always want to have more information on your property than the assessor. That could be pictures, images, pictures of comparable properties. If you're using income approach, your rent roll, your P&L, that you have more information about your assessor, and that will ultimately be better if you're having to defend your value in front of an appraisal review board, if you can show evidence that you know more about your property than the assessor does. In the formal hearing process, cross-examination is allowed. So you are allowed to ask the assessor questions. Sometimes it can be good to ask them questions to lead them down the road of showing a point that you're trying to make of where they are wrong in an instance, but you are allowed to ask the assessor questions, and vice versa, the assessor is also allowed to ask you questions as well. Lastly, during the formal hearing process, the ARB deliberates and they make a final determination. This is when you're sitting there and you're not allowed to say anything anymore. They actually close the hearing off and then they start deliberating and make a final determination. Let me go back here. There are a couple points I wanted to make. If you go through the appraisal review board process and you're not happy with your value, you do still have some options at your disposal. You can litigate, which the litigation deadline is 60 days from the day you receive your ARB notice. And you can also file for arbitration, and the arbitration deadline is 45 days after your ARB hearing. And so this does not end the process for you. You still have options that are available to you to pursue if you're not happy with the ARB decision. Most cases in here, I think last year it was around 14% of all ARB hearings went to litigation. We are seeing an uptick in litigation. The year before it was only about 9%. And so more and more people are litigating their value. One thing on litigation I did want to mention too is if you do decide to pursue litigation and the value changes, the appraisal district is responsible for paying your legal fees. And so there is another burden on the appraisal district during litigation. And so we've seen that be successful for a number of taxpayers on getting reductions if they pursue litigation, as long as they feel like they have a really good case. And that's something I would make sure and talk with a professional or an expert to review your case to make sure that you have that you do have a good argument. In conclusion, each property is unique, and property tax assessments do have a large degree of subjectivity. There's going to be different approaches that different consultants take and that you may even take, but there is no one size fits all method that the county is trying to use to fit your property in. Mass appraisal approach does have limitations. So just know that there is a negotiation that takes place. Whenever you present your information to the appraisal district, there typically will be a negotiation. You may not walk out there with your number exactly. It may be some type of number that's in between, but be flexible, maybe have a range of acceptable values that are available to you, and go in with a low value expecting to have some type of negotiation going back and forth. Be prepared in advance. Become familiar with your assessor and their preferred methodology. Do they like looking at equal and uniform? Do they like looking at income approach? I know some counties out there are still using the cost approach, although that's very rare now. Most counties have transferred over to the income approach properties for self-storage facilities. But the more you become familiar with your assessor, they know who you are, they know your property, the better that your assessments will be in the future. And communicate early and often with your assessor. Once you file a protest, don't hesitate to give them a call. Let them know, hey, I filed a protest, but I would love to talk to you about this property, about my protest before it's scheduled for hearing. I'd love to show you some information that I have about my property. This will let them know that you're willing to work with them and that you want to reach a value before it goes to an ARB hearing, or that you want to have an informal hearing with them. Additionally, partner for success. Property taxes can be difficult to understand, and a lot of the adjustments can be difficult to make. So having a professional help you can always be good for your case. I have one client that always says he likes plausible deniability. So whenever the assessor asks me for a profit and loss statement or their actual income and expenses, I can tell them, no, I don't have it. Whereas as an owner, you don't really have that ability to say that. And so, so there are some advantages to having a partner with it that is familiar with the process and knowing how to do the right approaches and picking which approach would be best for your property. Okay, so right now I'd love to get into some questions. Okay, so the Senate Bill 2, so the first question is, I came on late and can you explain how Senate Bill 2 affected our appraised values or did not affect them? So Senate Bill 2 affected the taxing rates that can be applied by the taxing jurisdiction, not necessarily to the values themselves. It limited the taxing jurisdictions to raise tax rates by 3% versus before it was 8%. This does not affect your value. Your value can still go up 50%, 20%, however the appraisal district figures out what your appraised value is or arrives at your estimated value. But the taxing entities themselves can only increase their tax rates by a certain amount. Additionally, what's important to know during this COVID-19 is once the governor declared a disaster, that 3% ceiling reverted back to the 8% ceiling. And so counties can elect to increase their tax rates by 8%. And due to the decline in sales and use tax, we are estimating and telling our clients to adjust their accruals for more than a 3% increase in tax rates. Okay, let me see the next question. I think I clicked the wrong button. One sec. Okay.
Next one is, what if we have an existing property with stable income and then you do an expansion that is not yet stabilized?
So if you have an expansion that's not yet stabilized, the county will most likely do a lease up on that property. And so they'll still start with the typical gross potential income and what you're able to bring in for that property. And even for the new property, if it's not stabilized, they'll do a lease up. And during this time, they typically estimate a lease up over a period of time, and it's a discounted cash flow that they're using. And so my argument right now, especially during this time, is for a lease up, it's going to take longer than what they're typically estimating. Offices are closed. People aren't coming in and able to lease as effectively as they were before in the past. And so I would argue for an extended lease up to the portion of the property that is unstabilized. You can also look at your cost data and apply a cost approach to that property and look at how much did it cost to build that property and apply that to it. Typically, we don't like to look at cost. Typically, cost is higher than doing a lease up. And so a lease up would be the best approach to take in that case.
Taylor, because we're running so long, we're at almost 12:15. I'm going to ask you these next couple of questions. Is fencing, driveways, et cetera, used by the appraisal district to calculate value of improvements?
I'm sorry, can you say that again?
If our fencing, driveways, things like that on the exterior of the property used by the appraisal district when they are calculating the value of the improvements done to the property?
Yes, they are. So if the appraisal district is using an income approach, they're taking in all the improvements that are involved in the process. So they're not adding in extra fencing or anything like that. When the property changes hands using an income approach, it's considered everything changes hands during the income approach. And so that won't be reflected in your square footage, but it will be reflected in the improved value just overall as a total. It's different than a typical cost approach where they may have a line item for parking or concrete paving or something like that. But during an income approach, it's automatically assumed that all the improvements that are involved with that property are included in the income approach.
Just a couple more questions, then we're going to wrap things up. This is an age-old question, which Elizabeth asked, can they raise taxes any amount they want, or is there a limit? You've already addressed the tax rate question with Senate Bill 2. I assume she means more in the broad sense of, can my value be increased any amount that the appraiser wants? Is there any kind of limit or ceiling or cap?
There's no limit or ceiling or cap on how much they can raise your market value. So they can, if they have evidence to justify an increase, they can raise your value as much as they want. But again, that's what the protest rule is there for, to allow you to challenge them and try to lower that assessment down. Most counties are becoming more sophisticated. They're getting better software and they're getting better data. And so they're getting better at projecting market values in their analysis. And so there is no limit as to how much they can raise your value right now in the state of Texas. They're only limited on what they can change your tax rate.
And Nick asks if there's any effect on school taxes with regard to that. I'm not quite sure, but he says with regard to Senate Bill 2, what about school taxes?
Yeah, the schools set their own tax rates, and so they do have a limit that is set at 8% for school. That's for all taxing jurisdictions, and so the tax rate set by the school or for the ISD that's in your district is totally up to them, and that's something that they vote on. Whenever they're calculating their tax rates, they set their budgets at the beginning of the year, so they know how much money they need to bring in. And then once the values are certified, they back into their tax rates. And so that's how their tax rates are actually calculated. They have the final value, which is their budget, and they have the total assessed value, and then they calculate what the tax rate is going to be based off those two factors.
And because we are running so long, we have one more question that we'll ask you, but it leads me to say something that we probably should have said at the outset, and you alluded to this, Taylor. If you don't protest your taxes, this kind of leads into this question that's coming up. You are part of the problem, because the values on the properties where there has been no protest get factored in as part of, the norm. And so we definitely encourage members to protest taxes, their valuation whenever it's possible, and to just kind of keep a cap on things. Because as you know, if you go to look at some of the values of your neighbors and you see that they are assessed much higher and they don't protest their taxes, that's going to roll forward. As Taylor said early in the presentation, that becomes a baseline and it's going to roll forward, and it's going to affect the taxes for everyone, the assessments. So that's my little soapbox statement. Taylor, this last question is that Miranda says she's having trouble with the appraisal districts that are going through and changing the rank of buildings, 1 to 2, 1.5. They change them up and down every other year. There are properties that are 30 years older with a higher building rank, making their value significantly higher than ours, which jumped that facility value over 60% this year. Can the appraisal district keep changing these rankings, or should they be staying the same to have a base? And someone's asking about sales tax. I don't think we're going to be able to get into sales taxes question, but I'm going to let you answer this last question and we're going to wrap things up.
Sure. So the rank that the county can use can change from year to year, especially if there are improvements made to your property, or they have a permit come through that shows that they gather information from the permitting department, and so they know if there have been improvements to their property. So if you have a 30-year-old property and you come in and you make a significant amount of adjustments to that in CapEx, then I would assume that the appraisal district would probably change the rank of that property or change the property class. But it's an evolving system, and as markets change and the demographics in the market change, it would be appropriate to change the rank in a property up and down. And a lot of times their ranks they're looking at what the self-storage facility is charging in rent, and that's how they'll change their rates. And so if you're charging $10 per net rentable square foot, that may change you down to a Class B property. if your market grows or the demographics change in your market and you're able to start charging more, they could change you to a Class A property once they look at your market rent. It's not necessarily how it's done in the real world regarding classes, but the appraisal districts are trying to do the best that they can with the information that they have and arrive at a market value that they can. So whenever people complete these surveys and they send in information, that's typically what changes ranks in properties, unless they see that there's been a significant permit pulled on a property or a cost put into a property that could change the effective year or age of the property.
Taylor, if you'll advance the final slide, we do want to thank our sponsor, Alert Building Systems, for the sponsorship today. I also want to put a plug in for a magazine article that Taylor penned for us recently. It's in our most recent issue. We sent the electronic issue out maybe 2 days ago, and I know that the printed versions are in the mail. I received mine yesterday. So look for that. It is very detailed. It is very helpful. Thank you so much, Taylor. Thank you, Alert Building Systems. This session was being recorded and will be sent out to all of the folks who registered. Appreciate you being with us today.